Most people spend their entire lives paying tax before they ever get the chance to spend a single cent of their earnings. In the standard financial system, you earn $1, the government immediately claims 30 cents, and you are forced to build a life with the remaining 70. This is the rule set for the majority, but the ultra-wealthy operate on an entirely different physics engine where they do the exact opposite. Instead of taking a salary, they let their assets grow completely untouched by the tax collector for decades. They have mastered a specific legal strategy called buy, borrow, die that essentially makes income tax optional for those with the most capital. By understanding this mechanic, you begin to see why the gap between labor and capital continues to widen every single year. To understand this strategy, you must first recognize the trap of the paycheck and the myth that a high salary makes you rich. Tax systems globally are designed to tax flow, money that moves from an employer to an employee or from a seller to a buyer. When you receive a bonus or sell a stock for a profit, you trigger a taxable event that creates immediate friction to your wealth building. The wealthy understand that to keep their money, they must stop it from moving through these taxable channels at all costs. By rejecting a traditional salary, they ensure that their reservoirs of wealth stay full while everyone else's leaks through the tax code. This shift in perspective is the first hurdle that separates the worker from the true investor. The first step of the strategy is to buy and accumulate assets that appreciate in value without generating taxable dividends or distributions. This phase is built on the power of unrealized gains, which exist on paper but are invisible to the IRS because the asset hasn't been sold. While a high-income earner might lose half of their $1 million salary to federal and state taxes, an asset owner whose portfolio grows by $1 million pays zero. This lack of tax drag allows their capital to compound exponentially over decades without being hindered by annual subtractions. It is a game of extreme patience where inactivity is actually the most profitable strategy you can possibly employ. They view their portfolio as a sacred reservoir that must never be drained by a sale. The second step, borrow, solves the problem of how to live a lavish lifestyle without having any liquid cash on hand. Instead of selling their stock and triggering a massive capital gains tax bill, billionaires pledge their assets as collateral for a bank loan. Because debt is not considered income by the tax code, the money they receive from the bank is completely tax-free. For the ultra-wealthy, the interest rates on these securities-backed lines of credit are often lower than the rate of inflation. This allows them to fund their lives while their assets continue to work for them in the background. It turns a static asset into a dynamic source of liquidity without ever losing ownership. This creates a powerful mathematical arbitrage where your wealth continues to grow even as you spend it on your lifestyle. If your $10 million portfolio grows at 8% annually, but you borrow $1 million to live on at 4% interest, you are still coming out ahead. If you had sold that same $1 million in stock, you might have lost $240,000 or more to capital gains taxes. By choosing debt over income, the wealthy protect their principal and keep the compound interest chain unbroken for life. This leverage becomes a bridge that allows them to bypass the friction of the tax system entirely. It is a mathematical certainty that paying interest is cheaper than paying taxes in this specific environment. Eventually, every investor faces the final stage of the strategy, which is the final phase of the cycle, die. Under current tax laws, when an individual passes away, their assets undergo what is known as a step-up in basis. This means the IRS resets the cost of the asset to its current market value, effectively erasing decades of accumulated capital gains. If you bought a stock for $10 and it is worth $100 when you die, your heirs inherit it at the full $100 value. They can sell it the very next day, pay off the loans you took out during your life, and owe zero tax on the growth. It is the most powerful wealth transfer tool in existence, allowing families to keep 100% of their gains. This transition from an individual mindset to a dynasty mindset is what allows old money to stay in power across generations. Most people plan for their own retirement, but the practitioners of buy, borrow, die plan for the next 3 generations of their family tree. They are willing to carry debt to the grave because they know death is the most tax-efficient event in their entire financial journey. It turns the steward of the capital into a permanent fixture of wealth that the government cannot easily dismantle. In viewing themselves as temporary managers of a legacy, they avoid the pitfalls of short-term thinking and individual consumption. They focus on the preservation of the reservoir rather than the size of the flow. However, a serious reality check is required before a regular person attempts to replicate this at a smaller scale. This strategy has sharp teeth, and the primary danger is a margin call during a significant market crash. If the value of your collateral drops too low, the bank will force you to sell your assets at the bottom of the market to cover your tax bill. This triggers the very tax bill you were trying to avoid and can leave an unprepared investor with absolutely nothing. Leverage is a double-edged sword that provides immense freedom on the way up, but can be devastating on the way down. Without a massive buffer, borrowing against your assets is a fast track to financial ruin. To succeed in this strategy, you must also be comfortable with the psychological weight of carrying large amounts of debt. Most middle-class financial advice is centered around becoming debt-free as quickly as possible. For the ultra-wealthy, debt is not a burden to be cleared, but a tool to be managed and optimized. They view the bank as a low-cost service provider that allows them to keep their capital invested in the most productive businesses on earth. If you panic and sell during a downturn, the entire strategy collapses and you are left with a massive tax liability. You must have nerves of steel to watch your net worth fluctuate by millions while remaining indebted to the bank. Beyond the math and the psychology, there is a deep ethical and systemic question regarding how this strategy impacts society. Because billionaires can avoid income tax almost entirely, the tax burden shifts onto the shoulders of those who earn a paycheck. This has led to repeated calls for a wealth tax or a change to the step-up in basis rule. But for the time being, these rules are the law of the land, and they are used by every major dynasty to protect their holdings. If the rules of the game favor capital over labor, it is your responsibility to move your efforts towards capital. Ignoring the reality of the tax code is simply a recipe for long-term financial stagnation. Ultimately, the lesson of the billionaire class is that wealth is built by owning things, not by earning wages. The entire global financial system is designed to tax labor while protecting and incentivizing the growth of capital. To win, you must stop thinking like a worker who trades time for a paycheck and start thinking like an owner who accumulates appreciating assets. True financial independence is found in ownership, discipline, and the refusal to let the tax code dictate your destiny. Once you understand these hidden rules, you can begin to move your own capital more effectively and build a bridge to true freedom. The choice is yours. Stay in the flow and be taxed, or join the reservoir and grow.